Good afternoon and welcome everyone to this American College CE webinar with myself, Jamie Hopkins. Will be kind of hosting it throughout the next hour on utilizing housing wealth in retirement planning. We have two experts here with us to kind of help us through this webinar and teach us a lot of kind of best practices, some detailed information, and some high-level stuff. So we're going to get a little bit of all of it. Shelley Giordano, who's the chair of the Funding Longevity Task Force, and then Barbara Stuckey, and I'll do a little intro on both of them here too, but also a member of the task force, a PhD, running a consulting business, has worked for numerous very high-profile places like the AARP. So a couple background things before we get too far in, because this is a CE webinar. If you are interested in American College Recertification CE or CFP CE, those are the only two types of CE offered here, American College and CFP. There will be two CFP code numbers. Those are required for CFP CE. They will be kind of on the screen, read out loud during the broadcast. The broadcast only works for live CE, meaning you have to be in attendance. At the end of the webcast, a survey link will be posted. You will also get a follow-up email later today to fill out the survey. In order to get CE, you must fill out the survey and put the CE codes in there if you want CFP CE. So again, CFP CE, you need to stay the whole webinar, get both the codes, and fill out the survey. That's the requirements there. I think that's most of the background information here. We'll also talk a little bit about the upcoming webinar for next month, but we'll do that at the end. So what are we going to cover today? Well, briefly, we're just kind of had the overview of the American College, the CE, some of the background. We'll then go into kind of the housing continuum here, and what do people want in retirement when they're living? Where do they want to live? And what are the options for them? We're also going to talk about some of the income ways that we can tap into home equity and draw money out of it. And Shelley Giordano will lead us through kind of the basics of the product that's really designed for that, reverse mortgages. Now, we will look a little bit deeper than that, too, in other strategies, lines of credit, downsizing, really using housing wealth as an income source. And then how do we coordinate housing wealth and where we want to live with our retirement income strategies? And then we'll kind of wrap up, and if we have time today, take a number of questions from anyone here. And typically on this topic, we do get a number of questions, as this might be new to a lot of people here. As I said, here are our three speakers. I will be kind of leading off, and at the end, and then Barbara Stuckey will be taking over next, Dr. Barbara Stuckey, after I'm done, and then Shelley Giordano walking us through some of the planning and reverse mortgage and housing specifics. Next part here, keep moving forward. Just briefly, I've been, because this is a American College CE webinar, I've been just kind of plugging very quickly really one program on two slides here that we run at the college, which is the Retirement Income Certified Professional designation. I know most of the people in the webcast have it. There are other CFPs, and it's an open webcast, so there are other people without it. We're continuing to promote that, support it, grow it, build it. It's really doing excellent right now. The one thing here, and this actually is probably ending next week, so yeah, this will be the last webcast at that price, and then we will be to a different price. So all three of the courses, if you buy a package of them, is $21.99, which is $251 less than the other package price. It's higher if you buy each course individually, but as this thing actually says, that expires October 31, so that will be the end of that pricing. We've been using this slide for months now, so it looks like we are finally about there. But just wanted to plug that. Now let's get into some of our material, why we're here today. And so the very first question, which is, why home equity? And I get that a lot, and I get why reverse mortgages, why home equity, why are we talking about this? And really, the main answer is it's just such big of a deal. But why we're talking about it today is because it fits into your retirement income planning. And I have this quote that I often use as a way to describe how I view retirement income planning. And I say retirement income planning can be like trying to hit a moving target in the wind. Well, why is it like trying to hit a moving target? Well, the target is really our retirement goals. What do we want to accomplish? And then why it's moving is moving up and back because we don't know how long we're going to live. If we knew retirement was going to be, right, 20 years, 1 month, and 6 days, well, we could come up with a fairly secure income plan for that time. But we don't know if retirement's going to be 5 days, 5 years, or 35 years. We really have no idea. Now, we can make some educated guesses about your longevity and your retirement length, but we really don't know with certainty. Then the other part there is there's wind. Why is there wind? Because things change in retirement, right? Your goals change, the economy changes, interest rates change, taxes change, public policies will change. If anyone thinks that Social Security, tax law, and Medicare will be identical today as it will be in 30 years, right? Well, that's a really interesting thought, but it's probably not based in reality. We don't see public policies and programs stay identical for 30 years. They need to change. So in some ways, we just can't plan on going from a straight line from point A to point B, right? Just in straight line. We got to come up with some other path. We have to have flexibility. And the other thing here is what I say is retirement income planning is really goal-based planning, right? It's that target. What do we want to accomplish? And then dealing with all that wind, all those risks along the way, longevity, inflation, healthcare, public policy, sequence of returns risk, long-term care risk, right? And then putting all of that together into a secure income plan. And then getting back to that first question I asked, why home equity? Well, this is a slide that I love using. And really what this came from is the U.S. Census Bureau, our last kind of census data. And it looked at the median U.S. 65-year-old retiring couple and said, what does their assets look like? And what you saw from that is about 2/3 of their home, 68%, right? That was their wealth. And 1/3 was in non-home assets. So when we look at the kind of average couple, and median's a good way to think about the true average couple, right? What is the median? What does the middle really look like? They look like this. They look like 2/3 of their wealth in their home and 1/3 in other things. And what this will also kind of answer for you is what ends up happening to most of these individuals is Social Security becomes paramount for their retirement income. But if we ignore that big blue part, that 68%, right, that home equity, right? That's their largest asset, right? We can't ignore that. It's just too big to ignore. And actually, it's all the way up into about the top 5% of wealth in the United States to where home equity actually becomes less than 50% of the individual's total assets. So it's not just in the middle where it's double, but all the way up until really we're starting to deal with high net worth clients, that home equity stops becoming the primary asset for retirees. Now, I want to turn it over now, and that's just kind of setting the stage, right? We're doing income planning, we're trying to shoot for goals, and we can't ignore the home. And so now I want to turn over here to Dr. Barbara Stuckey, who's going to really walk us through some of the, what we say, housing continuum, and where do people want to live? Why do they want to live there? And so, Dr. Stuckey, would you like to take this over?
Okay, thanks so much, Jamie. I appreciate being here today and talking to you about this. Okay, oops, here we go. Learning how to do this. So what I'm going to be talking about revolves around timing issues regarding the use of home equity to support people in retirement, particularly as they are considering their various housing options. Indeed, for many people, the answer to the question, what does the future of retirement hold, revolves around decisions relating to where to live and when to tap home equity. The sad fact is that some people need to sell and move relatively early in life because of financial challenges. But for others, they see themselves as moving through a continuum from independent living to perhaps a retirement community that can help them reduce the strain of household chores. And then as their health and ability declines, to assisted living and maybe even to a nursing home. And within that sort of traditional framework of thinking about the house and home equity, there is a general sense that home equity should be preserved as a last resort to pay for costly institutional care. So what I'm going to be talking to you today is to highlight some of the winds of change, as Jamie mentioned, that are already affecting the housing continuum and which will likely have an impact on the timing of decisions regarding the liquidation of home equity. So one of the big changes that's going on right now in this sense of where people are going to live and at what time they're going to tap their home equity is the fact that traditional care settings are becoming less attractive. The data I'm presenting here in the next several slides are survey of executive and experts in the senior living industry who are responding to the housing preferences of older Americans. And what they're doing is they're shifting their focus away from these traditional age segregated retirement communities and assisted living facilities. Indeed, in 2017, only 38% saw their future as being driven by creating or supporting more retirement communities, which is the pay as you go. And that's obviously a significant drop from just 2 years ago. And only half believe that the comprehensive, the CCRCs or continuing care retirement communities, the ones where you have everything from independent to assisted living to nursing all in one campus, 52% of them feel that this kind of a model is actually endangered, that we're not going to be seeing a lot of this going in the future. Another institutional setting that we oftentimes think of as a housing option is the assisted living facility. And again, very dramatic decline in the number of folks in the senior living industry who really think that this is going to be the model of the future. Only 10% think that this is going to be the attractive way of providing this kind of service and support in the future. So the idea of selling and moving is not what we are looking at as we are in the future. Indeed, these experts really see that providing assistance in the community is where the future lies. In fact, new business models are being developed that focus more on housing in urban settings, and where seniors receive on-demand support for aging in community rather than in them having to move to meet their needs. One new model that is coming out is this concept of apartments for life, which are in lively communities, oftentimes near universities, that are adapted with grab bars, and where the idea is that the services are being brought into the home. And again, you can see that there's a lot of interest moving forward in this kind of a housing model. Similarly, the senior living industry is focusing more on creating networks in the community where they're bringing various service providers together to provide a more holistic and integrated approach for people to stay in their homes rather than move. In fact, if we want to say what does the future of retirement look like, this is an example of what that vision might be. Rather than having old-fashioned senior centers, we're starting to see these fancy new centers for healthy living. I mean, they look gorgeous, they're comfortable, that they're designed for people who are living in their own homes, so that people are using their money to pay for services rather than to pay rent to the facility. They have multiple programs. They're often integrated with health and nutrition, as well as activities to keep people in the community for as long as possible. Again, they're based on leveraging existing partnerships in the neighborhood to expand the delivery of services and support aging in community. This is what particularly baby boomers are saying that they want, and this is probably what the future is going to be looking like. Now, from a home equity perspective, this does present a challenge because these services are obviously not going to be cheap. They're going to be cheaper than moving, but you're still going to be paying out of pocket largely for these services. So that older people will be needing cash, but they will no longer be liquidating their house to meet this kind of needs. So the question then is, who and how are we going to pay for these very positive services for aging in community? Well, the general sense is that that this is going to stay a strictly private pay option with people paying out of pocket. 74% of those in the senior living industry are optimistic that Medicare will pay for some of these services. And indeed, very recently, Medicare announced that Medicare managed care plans can now start covering services such as transportation and nutrition. But these are still oriented towards people who have serious medical needs, not for people who are just living in the community. And I think there's a general sense by all people that long-term care insurance is probably not going to be a solution either. So ultimately, what this means is that the conventional strategy for using home equity as a last resort may leave many seniors short. And I think that's why there's growing interest in products such as reverse mortgages that allow seniors to tap home equity and stay in their home. So I'm going to turn it back to you.
So that was great information. Thank you. And now I'm going to turn it over to Shelley Giordano, the founder and chair of the Funding Longevity Task Force here at the American College. And Shelley, would you like to step in and take over?
Yeah. Thank you, Jamie and Dr. Stuckey. Gosh, Dr. Stuckey, you painted just a great picture here for the preferences going forward for an equity release product, which in the United States is known as the HECM. So we're going to take a look at this government-insured home equity conversion mortgage. It represents 95% of the reverse mortgage market, although recently there's been a resurgence in the private jumbo market. Unfortunately, we are stuck with this unfortunate acronym HECM. We actually like the term home pension a whole lot more, and that's what they call the reverse mortgage program in South Korea. So the HECM is tightly regulated by the government insurance program, the Federal Housing Authority, which is part of the Department of Housing and Urban Development. First and foremost, the HECM is a non-recourse loan. No deficiency judgment may be taken against the borrower or his estate. And the homeowner maintains ownership throughout the loan, as well as when he exits the house. So he's not giving the house over to the bank, which we continually see claimed by reporters and others who haven't even done the most basic research on a reverse mortgage. So just like any other mortgage, the HECM allows the homeowner to hold on to home ownership. The HECM is available to homeowners who are 62 or over, who have roughly 55% or less in their home. That all depends on their age. The home is not required to be owned free and clear, but the HECM will have to take first lien position. So the homeowner must demonstrate willingness and capacity to meet homeowner obligations such as property taxes, hazard insurance, and reasonable maintenance and HOA fees. And again, this is just like any other mortgage. There's no complexity or thing hidden in this aspect of the HECM, just like any mortgage, or even if you don't have a mortgage, you're still responsible for your property taxes and hazard insurance and your HOA fees. The FHA requires an independent counseling session. Counselors emphasize to the homeowners that there are tax and insurance obligations. And even though they're not making payments on the HECM typically, the HECM is still a loan and interest is accruing. There will be an FHA appraisal to establish the home value and make sure the home is in safe shape. And actually there could now, today, even be 2 appraisals. The home must be the homeowner's primary residence, although snowbirds are allowed. That'll be important to many of your clients. There is an FHA lending limit of $679, $650. More expensive homes are always allowed in the program. And actually, we're starting to see higher value homes over time now. But the equity above the limit does not garner more credit eligibility. So there is a floor. So we're going to go to the various borrowing options, and you're going to see that the HECM is tremendously versatile, and it can be structured with a variety of draw options. The first, line of credit. A line of credit can be established when you set up the home equity conversion mortgage HECM. It is absolutely unique in financial services. There's really nothing quite like a HECM line of credit. This line grows in borrowing power at the cost of money, and it cannot be canceled, frozen, or reduced. So this is important because, as you know, during the Great Recession, just when your clients needed liquidity, the banks choked off the money supply. So this line of credit will continue to grow. This is the most amazing thing, and people can't really get it in their heads till they do some studying. But that line of credit grows regardless of what the underlying collateral is doing. In other words, if home value drops, it has no effect on that growing line of credit. There's a tenure option. So this is a way to annuitize your client's equity and provide supplemental cash and reduce demand, thus reducing demand on their portfolio. But unlike an annuity, they don't lose what they don't use. So that's a distinction between annuity and an annuity in a reverse mortgage. A lump sum is possible, and the cost of doing the lump sum option actually has dropped significantly since the changes instituted by HUD FHA on October the 2nd, 2017. But a lump sum is generally used to either replace a current traditional mortgage with a mortgage that doesn't require principal and interest payments, or to assist in divorce settlement. Or you can mix and match these. And then we also wanted to point out that there's a relatively new option, H for P, it's called here, our whole HECM for purchase. And what it does, believe it or not, it allows a client to combine a down payment of around 55% or less, depending on their age, with financing that comes from a reverse mortgage at the closing table. So they can then, after they move into the new house, let's say half is cash, half is a reverse mortgage, they can live in the house without a mortgage payment. And so obviously this kind of financing feels like a cash purchase, but they didn't have to spend out of their portfolio, and they don't have to make those monthly payments, so they get that cash effect of having no payments, but yet not having to draw heavily on the portfolio. Let's go to the next slide here. So everybody wants to know what HECM costs, of course. So you will want to know that most of the upfront fees that are involved in setting up the HECM are rolled into the loan, but they can be paid out of pocket if that is a better situation for your client. The largest expense is the FHA upfront mortgage insurance premium, which is 2% on the home value up to the FHA lending limit, but it's important to really be clear what that FHA mortgage insurance does. It provides the non-recourse insurance, and it guarantees access to that growing line of credit or the promised tenure payments. So reverse mortgage really can't work if there's not a non-recourse aspect, and if people can't have absolute confidence that what they're signing up for and paying for is not going to provide, it will provide for them what they're expecting from their home equity. There's an ongoing MIP of 0.5 point, and that has come down, and that's 0.5 point based on the loan balance. The interest rates are similar to traditional FHA mortgages, but since October the 2nd of 2017, the margins that are attached have dropped significantly. And then there are third-party costs as in any mortgage, and those are similar to the traditional FHA mortgage. So our panel agreed, if there's one takeaway from today's presentation, it is, and Dr. Stuckey's already mentioned this, reverse mortgages are not a strategy of last resort. If you're fond of saying this, and believe me, I run into people on a weekly basis who say, oh, those reverse mortgages, they're great as a last resort. Just wash your mouth out with soap, as I say to my children. It's not true. The wait and pray strategy, hoping that the portfolio will last 30-plus year retirement, and then hoping, that there's going to be a reverse mortgage downstream 30 years from now that'll bail your client out, is the worst way to use a reverse mortgage. So we're going to take a look at some solutions here. So home equity income streams, there are some other choices other than a reverse mortgage. From generating income from the house. But as Dr. Stuckey mentioned, what your clients really want to do is stay put. They want overwhelmingly, survey after survey, to be able to convalesce in the comfort and security of their own homes, whatever home that configuration that takes. But there are other things that people are doing, home sharing like the Golden Girls, a HELOC possibly, but there's so many limitations to a traditional HELOC, family leaseback, family charity, downsizing, all of these things that clients just are telling us in the market out that they're not interested in doing. So if your opening recommendation to your client is, oh, just you can just downsize, that may not be the advice that they want to hear from you. So, as Professor Hopkins is fond of saying, a good retirement relies on cash flow. So during our working lives, he says, we're looking for location. We want good schools, and we want to be close to work, and we want a prestigious neighborhood. But in retirement, it's really about cash flow. And so there are a few ways you can turn on cash flow. You can find more income, which will improve your cash flow instantly. But of course, that's not so easy to do in retirement with no labor income. Debt management, turn off the outflow, reduce your mandatory fixed expenses, or ratchet down your spending. And of course, that's never popular advice for you to give to your clients. Protect your income streams. And so this is protect your income streams in a market coordinated manner. So you do this by coordinating your housing wealth with your client's other assets. The longer your client lives, the greater probability he's going to encounter volatility cycles and possibly very severe shocks to his cash flow. So again, the panel wanted to provide a graphic for you on this. So what cash flow must cope with in retirement? So we're hoping that you're going to start thinking about the HECM as this giant shock absorber. So let's start with the shocks that can happen, just a few of them actually, that can happen in retirement, starting at the top here and going clockwise. Liquidity shock. Well, just when you needed liquidity, so did the banks during the Great Recession. Divorce shock, devastating when there's no labor income and assets have to be divided between two parties who are breaking up. Inflation shock. We haven't had much of that recently, but we know historically that inflation can erode assets' values just dramatically. Dental problems. Don't laugh. This is a big deal with people later in life, and it's not covered by Medicare, and it's integral to people's sense of well-being and their health. Housing value shock. Will we ever get over the crisis of 2009 with a crash? Health shock. We know how expensive that is. Car repair, HVAC, all of those things that have to be dealt with, that if you're on a fixed income or your portfolio has shrunk, they have to be dealt with, and it's tough for people. Hearing aids, not covered by Medicare, and terrifically expensive. But the thing that we're really focusing on here today is portfolio shock. And that's when the portfolio is temporarily undervalued, there's a bear market, and that just highlights the need to conserve the portfolio assets in bear markets and mitigate sequence of returns risk. So here's a kind of a comprehensive list of possible HECM applications in retirement. We're going to focus later on just a couple of them, but paying off an existing mortgage, having the cash to have those home renovations to age in place, HECM for purchase for a new home to be near the grandchildren, spend home equity first to leverage investable asset growth potential, sort of arbitrage there, coordinate home equity to mitigate sequence of returns risk, use tenure payments to reduce portfolio withdrawals and keep them at a more sustainable level, use tenure payments as an annuity alternative. So you don't have to fund the annuity with a portfolio draw. You're funding it with your housing wealth, out of your housing wealth. And what you don't use remains your property. So if you don't use it, you don't lose it. Use the HECM for a few years to effect a Social Security bridge so that you can delay your Social Security and get the maximum benefit from that. Tax bracket management. Draws from a reverse mortgage are tax-free proceeds from a loan, and don't put your spending in a higher tax bracket. Roth conversions. Take the sting out of Roth conversions and pay it with your home equity. Long-term care insurance. If you've got it ongoing and you don't want to give it up, reverse mortgage can be used to continue to pay those. Or home care payments, much like Dr. Stuckey was talking about, pay as you go. You know, I can live in my home if I have a little bit of help. How am I going to do that? I can significantly improve the quality of my life if I can release some of this equity. Can be used as end of the life planning source, protect the home value. Again, want to call your attention to the fact that the HECM line of credit grows regardless of what home values do. So it's always there for you. You set it up early. And there's no question of 20 years, 30 years down the road, you know, does the reverse mortgage exist? Our home value is so terrible, I can't get a reverse mortgage as my credit profile drops so precipitously, I can't demonstrate I can make my willingness that I'm willing and capable of making my home payment. All of these are unknowns that can be eradicated by setting up the HECM early in retirement. And of course, the contingency fund, our proverbial shock absorber. So here's some strategic HECM solutions, and I'd like to start with what Professor Hopkins' colleague, Professor Wade Fogg states. The fewer fixed expenses in retirement, the less stress on the portfolio in market downturns. So refinance that traditional mortgage. It immediately reduces mandatory fixed payments. So right away, there's less stress on the portfolio and the cash flow. And anybody who's done a budget understands this. But I'd also like to call attention to the latest research by Dr. Fow that suggests that clients can make voluntary payments on their reverse mortgage, on this mortgage that they've replaced, in good times, but stop making them in market downturns. So again, this just underscores the tremendous flexibility of the home equity conversion mortgage, that you can start and suspend payments at will with no consequences whatsoever. Home purchase, H4P.
Hey, Shelley, yeah. I think maybe here it would be a good time probably to actually talk, and we can kind of do this between the three of us, maybe actually talk about like the type of client that might make sense here, right? Like kind of watching the questions, I'm seeing some of that. So as you brought up the refinance piece, right? You know, I give a little example here, and then you can chime in on this one too. As you brought up, as Wade's talked about, right, that you know, having as few fixed expenses as possible. That's actually a great business model too, right? A lot of businesses try to run that way. And if you run your finances that way, it could be good too. An interesting thing, and it is worth bringing up here, that the IRS does treat paying off a traditional mortgage as a refinance if you use a reverse mortgage, right? So that actually is treated as a refinance, which can have some tax implications if you had originally purchased your home and taking out a mortgage, right, to acquire substantially approve the home, that interest under the new tax law up to $750,000 of debt principal, or up to $1 million if it was prior to, right, 2018, would the interest on that would be deductible. So if you paid off, say, a $400,000 or $300,000 traditional forward loan that was used to acquire your home, you paid that off with a reverse mortgage refinance, you actually get to continue on that deductibility of interest, assuming the interest is actually paid. And Shelley, you sometimes talk about that piece, right? If the interest is actually paid, and there's some research from Barry Sachs, correct?
Yes, correct. Yeah. If you don't get the interest deduction unless you've actually paid, so the accumulating interest is not a tax deduction unless you're actually paying it. And then you do need to zero out the part of the loan that was part of the mortgage insurance premium and servicing fees, if there are any. Not many reverse mortgages have that any longer, in order for the tax deduction to be allocated to interest.
Okay. And then, yeah, so I think that's so probably anyone, right, that's kind of getting to retirement that has that ongoing mortgage payment, right, refinancing into a reverse mortgage could make sense for them. I also think I like to bring up the idea about the way that the interest rates are done, is that some people say, well, reverse mortgages are expensive, right? And you've heard that before. And we say, well, compared to what? Often, right, if you have somebody who had as poor credit at that point or not a lot of income, they might not be able to refinance under kind of favorable rates to a traditional 30-year mortgage, right, in, their mid-60s or 70s. But they might be able to refinance actually at an even lower rate if they use a reverse mortgage. So that can happen too, right, Shelley?
Yep, absolutely. Yeah.
Okay. Well, I guess you can go on to the home purchase one. Sorry, I jumped in and interrupted, but I was like, there's some fun stuff I like about the refinance.
Spoken like a tax attorney. We appreciate that. So again, you can purchase a home using the HECM for purchase, and to Jamie's point, if you're making payments on that and it's a home purchase, that would be a tax deductible interest cost. So coordinated strategy. So this whole concept got started with Dr. Barry Sachs, really actually starting back in 2004, believe it or not. And the idea of that is just to protect the portfolio from truly scary adverse sequence of returns, especially early in retirement or a prolonged adverse sequence of returns. And the idea there is to substitute using draws from your reverse mortgage, your HECM, in years when we have a losing portfolio. So, whatever you do, avoid taking draws from a portfolio that's undervalued. Jamie, you want to say anything more about that one?
Well, I mean, I guess I might throw kind of the question over. Where are you seeing, because there's some areas where that's being used more frequently right now, right? So where are those areas in the kind of around?
Well, I would say that this kind of strategy is probably more interesting to people who have a little bit of discretionary income and some actual assets to be protected. So, in the past, reverse mortgages tended to be marketed to people who really, the home equity was the last resort. They'd been through absolutely everything. And now it was sort of like last gasp. Let's see if we can avoid kicking the inevitable can down the road for a couple of years and put them in a reverse mortgage, which was a disaster for not only the poor clients, but also for the program. So now that the financial services advisory group has started to pay attention to home equity conversion mortgages and housing wealth altogether, you're starting to see people who have assets that need to be protected, who have good collateral in their home, who have a good understanding of what the longevity challenge is. And we know it's kind of unfortunate to say this, but we know that people who have a lot of financial capital and social capital tend to live longer. And so one of the things to watch out for is how do you really protect that portfolio if you're going to have a 30 or 40-year retirement?
Yeah, and one of the things I like to talk about on this one here is often I say to people, well, what if we had three assets, right? And I just tell you we have three assets and they're close to the same liquidity, but one is going to give us a, 3% return, one's going to give us a 5% return, and one's going to give us a 7% return. And I say, so we have these three assets, you don't know the name of them, they're just three assets. And I say, well, which one would we want to let sit for the longest period of time? Right? And the answer for that is typically fairly straightforward. It's, well, I'd want the one that grows at 7% to sit for the longest period of time. Well, if you're looking at, right, your kind of safe investments, your, right, house, and your stock investments, well, the stock hopefully will, over a long period of time, be able to do something around 7%. Your safe assets might be closer to 4%, and housing basically tracks around 3.2% or so. If you look at the Schiller index, over the last 100 years, that's really all housing has done. It keeps pace with inflation and provides no additional returns. So if you think about which of those assets would you keep to the end of retirement, well, keeping the one that just keeps pace with inflation to your last asset isn't actually what makes sense. It's not what we would do any other place. Now, the reality is you need a place to live, so we're not saying you can just completely liquidate that, but using that strategically throughout, right, as a coordinated and kind of non-market correlated asset can be very powerful. I think the next one, we actually want to jump forward on the divorce. We could jump back to this slide for the last one, too, because I know we have another slide on that, Shelley.
Mm-hmm. Right, yeah. Yeah, well, we'll talk about divorce on our next slide, but we do want to continue to emphasize for you the power of the Heckham line of credit. Compounding is a miracle, as some mathematician said, when it's working for us. So we encourage you to learn all you can about the Heckham line of credit because it's got that compounding growth feature. So starting the Heckham line of credit early in retirement makes the most of that compounding growth. You get years and years and years of it if you don't have to use it. It can't be taken away from your client. And if they don't use it, it reverts to equity. So again, it's this: if they don't lose it, if they don't use it, they don't lose it. So a Heckham line of credit is a particularly good way to hedge self-paying long-term care. You don't know what your responsibilities are going to be years out, but you've set up this growing line of credit and earmarked it for that need to take care of yourself in your home, if you need it. And if you don't use it, then of course it's just equity in your house that's still there. So we wanted to do a slide just on the divorce issue, solutions using a Heckham, because not too many people know about it. And it's a pretty elegant solution to what is an increasing problem for people in or near retirement. They're just getting divorced. So traditionally, the home would be either sold and the equity divided, or one house would buy out the other. So this arrangement necessitated either mortgages for the person, for both people, usually, or a big cash distribution from the portfolio. So this leaves, the spouses scrambling for housing equal to what they're used to, their marital home. So, and anecdotally, we've heard from grown children that it's often the mother who really doesn't want to leave the house, and the kids don't want the mom to leave the house either. So we're looking for a solution to that. So if you look at solution number one here, what happens is you put the Heckham on the house, and that will provide about 50% of the value of the house typically. And so let's just call this the wife or the mom. The mom gives 50% of the value of the house in cash to the husband. And then he takes that spousal buyout money and leverages it with this Heckham for purchase, and he's able now to buy a home. He doesn't have to live in a little sweaty apartment somewhere. He gets a nice home as well, if that's what he wants to do. But there are no mortgage payments, and there wasn't a big capital outlay on from the portfolio. Or another solution is for both of them just to go ahead and sell the house, and then they'll use the cash, half of the cash as a down payment, but again, leverage that down payment for the Heckham for purchase. So now the first spouse is living in a house, second spouse is doing the same thing, taking the down payment and then leveraging it with a HECM for purchase and buying basically double the house. Neither one of them has payments, monthly principal or interest payments until they die, move, or sell. And again, there's money left over in the portfolio. So that sort of brings it to an end where I go, Jamie, and we turn it back over to you.
Thank you. So we did get a lot of questions. I do want to essentially kind of close on some remarks first, and then we're going to try to get to as many questions as we can here. We should have a good shot at actually covering a number of these. But I wanted to kind of reflect back kind of on what Barbara Stuckey said earlier, right? That housing is not static in retirement, that there is a continuum, and what people want is complex. Now, if we're using a retirement income planning process that looks at what people want, it's goal-based, right? Staying at home, aging at home, finding the right care facility, and being able to age in place is incredibly important, which also requires us really to look at the house as a strategic resource. Now, for some people, right, that will be kind of their funding mechanism for long-term care. They will be leaving it as a legacy goal. But really, if there's, one of our three main takeaways from this is, right, just pay attention to the housing wealth, right? What is it being used for? The other piece there, right, is, keep up with what changes here in the research. That's kind of been mentioned throughout. There has been a lot of research going on in this area, but only for a short period of time, right? Kind of going back to, maybe 2012 when this really started amping up, looking at reverse mortgages, looking at debt repayment, looking at downsizing, and other home equity options. The other thing here, kind of down at the bottom, right, is cash flow is king in retirement. We need cash flow. And, right, reverse mortgage is not an asset of last resort. And kind of, I'm going to handle this one question that was brought up. It talked about FINRA's, as I think they said, disdain for reverse mortgages. Well, if you read FINRA's report, that their investor alert on reverse mortgages, it's actually not quite that. We have a lot of people that tell us that. They even say, well, FINRA says only use it as a last resort. Well, something that this task force and one of our members, Barry Sachs, was instrumental in having done is FINRA no longer uses that language of last resort. They actually removed it from their investor alert. Instead, now it says that reverse mortgages should be considered, right, as part of a retirement plan, and it works in the right situation, and that the trusted advisor should be, right, contacted by the consumer, right? That's what they're saying. So they're saying consumers, investors, contact your trusted advisor about this. So really, if you're unable to talk about them, unable to handle them, right, in my view, right, it's saying that you're not their trusted advisor, because FINRA is saying in order to do this correctly, you need to talk to a trusted advisor. And if you're unable to do that, well, you're not really filling the role in FINRA's world of trusted advisor. Now, kind of in many areas, this one being included, this is a debt obligation. You are borrowing from your house, like borrowing in any other way. It is debt. And because of that, there's always hesitancies to taking on debt to buy products, taking on debt to just spend everything the next day, to taking on debt to buy investments. Those things actually, and I think probably everyone on this group is probably opposed to kind of taking out debt on your house, whether a forward, reverse, credit card debt to buy, right, stocks or buy Bitcoin or any other type of thing like that. That's a very difficult proposition. Now, some areas that's allowed. We see people that use debt to finance their investments. But often financial advisor firms and everyone's going to be hesitant on that. There's obviously an extra amount of risk. So I do want to, let's hit a couple questions here first. So Shelley, this probably is a good one for you. So how is the line of credit interest rate set? Is it always fixed?
Well, the rate is not fixed, but the formula is fixed. So the line of credit is only available on adjustable rate loans. So an adjustable rate loan, whatever loan balance you have, is going to be assessed these components of the rate. The index, which right now is a LIBOR, plus the margin that you chose at closing and half a point of the MIP. So that's how the loan balance grows. And no, this is not intuitive at all, but the line of credit grows at exactly the same rate. The monthly applicable, the monthly applicable note rate LIBOR plus whatever margin you chose at closing plus half of the MIP.
Okay, excellent.
So it's always there's no change in that. What changes is the underlying index, the LIBOR index.
Right, as that changes over time. Another thing here, I'll just briefly answer this one. The HECM laws changed last October. Do these discussions factor in those changes? Yes. Everything we discussed today factors in the October changes last year that are kind of now up and running. I guess, let's see. Yeah, so this one here, is it possible that the HECM is larger than the value of the property over time? Then what happens? I think this could probably go either way. Either they're saying the debt obligation is larger or the line of credit is larger. Dr. Stuckey, would you want to comment on either one of those two, or Shelley, or a combination?
Well, I'm happy to talk about it because it is possible that the line of credit could grow to be greater than the value of the house. We don't know what the value of the house is going to be. I actually know somebody in the reverse mortgage business whose mother had a $70,000 line of credit, and during the housing collapse, the value of her home just dropped, and she was able to go in and take the line of credit out, even though the value of the house was less. I mean, the line of credit was greater than the value of the house. That is possible. We as the task force do not support or advocate that people set up lines of credit in order to deliberately cause the line of credit to grow greater than the value of the house. And it's really hard to do that now because of the changes on October the 2nd. But there was a sort of gallop toward a ruthless option, as we called it, where there were some financial planners trying to put their folks into a high margin line of credit that was designed to outstrip the value of the house. But that's not good public policy and hard to do now.
Shelley, you might also want to highlight the fact that this is where the mortgage insurance premium comes into play. And some people are concerned about that cost, but that is part of the package here with this line of credit.
Oh, absolutely. So the mortgage insurance, make sure that this is a non-recourse loan, so you're not having to ever have personally liable for the debt. And if for some reason your house does not equal the loan balance, which includes taking whatever's in the line of credit, you're completely protected.
Yeah. Another one here, actually kind of maybe both of you can weigh in on this. We have an advisor in here saying, if I want to talk to, compliance or my clients about this, any recommendations on kind of best practices as I, bring this up with clients or as I bring it up with my firm, to kind of talk about, right, just using home equity or reverse mortgages?
Well, so that's one of two questions. So the first one is in talking to your clients, I wouldn't surprise them all, catch them unawares. I know that there are advisors out there who send out little newsletters and that sort of thing, and they kind of work in discussions about reverse mortgages, kind of warm everybody up to the idea. And start early talking to people about you want to conserve your home equity. If you're 50, don't be using your reverse mortgage for consumption. Of course, now the tax law it helps you with that. And then talking to your compliance people, we do know, and Jamie can help us with this as well, but we do know of some advisors out there who've gotten a group together and approached their compliance departments and said, you know, we don't feel like we can give the best possible advice when we're basically ignoring 2/3 of a person's assets. And so we need to think about this. And so we know one large financial services group got a resource group together, and they worked on it for about 6 months, but they had all the lawyers and the marketing people and the people who wrote the software people and people who wrote the financial planning parts and the broker dealer end of it, everybody. And they finally concluded just that, that they felt like that they were more at risk if they didn't discuss the housing well, if they didn't think about cash flow, to Jamie's point, for their clients, than if, you know, somebody somewhere did in their organization tried to do something untoward with somebody's home equity. We are seeing a change out there, but if you're on the line and you, you know, are on the front lines with your clients, it may take a group of you together to approach your compliance folks and say, hey, look, you know, forget fiduciary responsibility. It's not even a suitability standard to ignore this asset. And then of course we've got the SEC Reg Best Interest, you know, coming down the pike. So it would behoove people to be ready for it.
One thing I would want to add to that is don't forget the adult children. A lot of older people are very concerned that as their health and ability declines, that they will become a burden to their children. Mm-hmm. And oftentimes it's where the house that comes into play, and doing things before there's a crisis through this proactive equity release can be a huge benefit to the adult children.
Great
Excellent
point.
Thank you, Shelley and Dr. Stuckey. I just want to close last two slides and give the last CFP code. So one thing now in the chat box, you'll see a link actually to register for next month's webcast, which is November 26, 2018 at 3 p.m. with Bill Borden and Deborah Newman. And mostly in there, we're going to be discussing the kind of new development of hybrid-based long-term care insurance policies. So you can register for that. The survey link will also get put up for this one here. It will be in the chat box now. It will also be emailed out after the webcast ends. One last thing here, I guess, again, thank you both American College, Dr. Stuckey, and Shelley Giordano. Shelley, I know we got a lot of questions in here that were not answered from advisors. It's kind of up to you. Would you like to share an email or anything with them? We could have that sent out, or just get you a list of the questions if you want to reach out to them.
I mean, I'm happy to give my email address at Shelley, SHELLEY, at longevityview.com. But I do believe that there will be an Excel spreadsheet with the questions on them, and I will answer all of them once I get them.
Well, Dr. Stuckey and Shelley, thank you so much, and thank you for everyone for attending. Have a great rest of your day and week.
Thank you.
Thank you.